The world's largest liquefied natural gas exporter is running out of domestic gas. That sentence should not be possible, yet the Reserve Bank of Australia is actively modeling a supply shortfall arriving before 2030, and the chief executives of Santos, Shell, and Woodside Energy all turned up in Canberra on Tuesday to say the government's plan to fix it could make things considerably worse. The ASX 200 bounced 1.17% to close at 8,604 points, lifted by reports that Donald Trump had called off a planned military strike on Iran after assurances from Gulf leaders that a deal was close. About 20% of the world's oil and gas supply moves through the Strait of Hormuz, and the prospect of that shipping channel reopening pushed energy and consumer staple stocks sharply higher. Woolworths climbed nearly 5% after JP Morgan upgraded the stock to overweight with a price target of $37, arguing the share's recent fall to the $32 to $33 support zone had more than priced in the margin headwinds that spooked investors in late April. The broader consumer staples index surged 3%, outpacing every other sector. Technology shares and materials moved backwards. The session's apparent story was straightforward. Geopolitical relief drove the recovery. But the gas industry's intervention in Canberra introduced a second, slower-moving tension that the Iran headline obscured. The Albanese government's new East Coast gas reservation policy, due to take effect from July next year, would compel LNG exporters to hold back the equivalent of up to 20% of their annual export volumes and make that gas available to domestic buyers. The policy was designed to address a real problem. The decades-old Bass Strait fields are depleting rapidly, and Victoria, New South Wales, and South Australia face a domestic shortfall that will put upward pressure on household energy bills and threaten gas-intensive manufacturers. Santos chief executive Kevin Gallagher warned that forcing producers to sell, not merely offer, domestic gas at regulated conditions risked destroying the economics of new investment. Australia risks going the way of Argentina, he said, referring to a country that once held one of the world's most promising gas industries and subsequently watched investment evaporate after export curbs made new projects unviable. The question the gas executives raised was not whether a domestic shortfall exists. They acknowledge it does. The question was whether the cure would accelerate the disease.
The arithmetic behind Australia's gas position is what makes the policy collision so difficult to resolve. Australia ships more LNG than almost any country on Earth, yet the pricing and contracting structure of that export industry means the gas flowing through Queensland's export terminals is largely locked into long-term overseas contracts. Domestic buyers in Eastern Australia are competing against international contract prices denominated in US dollars and indexed to oil. When the Strait of Hormuz closes and oil rises, domestic Australian gas prices rise with it, not because Australian producers chose to export more, but because the domestic price is structurally linked to the export netback. The reservation policy attempts to sever that link by compelling a portion of supply to stay onshore. Santos, Shell, and Woodside argued that compelling a sale at conditions they consider uneconomic would deter the very capital expenditure needed to bring on the new fields that are the only long-run solution to the shortfall. The counter-signal worth tracking is who is absorbing that risk right now. Northern Minerals became a separate illustration of where capital allocation anxiety is running. The federal treasurer issued a fourth consecutive order requiring 6 China-linked entities to sell their combined 17.5% stake in the heavy rare earths company. The previous 3 orders were effectively ignored. One of the named investors, Hong Kong Yingtac Limited, appears to have purchased an additional 3.79% of the register after the most recent disposal order, a move the Foreign Investment Review Board described as a defiance of Australian sovereign authority over its critical mineral supply chain. The government gave the investors until July 2nd to comply. The rare earths episode matters here not as a separate story but as a condition. The same government is simultaneously trying to hold Chinese capital out of critical minerals and compel domestic gas investment under price constraints. The capital that finances new gas fields is watching both signals at once. The reversal the gas executives are pointing at is this. The reservation policy was designed to lower domestic prices, but the mechanism it uses could raise the long-run cost of supply by suppressing the return profile on new projects. Argentina's gas industry did not collapse because producers suddenly chose not to invest. It collapsed because the investment pipeline dried up over a period of years after regulatory conditions changed, and by the time the shortfall became acute, there was no quick way to restore supply. Bass Strait fields are already declining. The lead time on new LNG-capable fields runs to a decade. If the reservation design discourages the next round of development decisions, which are being now made, the shortfall before 2030 becomes a permanent feature rather than a bridgeable gap. The unresolved question from the paradox layer is this. If the reservation policy is calibrated wrong, by how much and how quickly would the damage become visible? The RBA's chief economist, Sarah Hunter, provided a partial answer on Tuesday. Hunter warned that if Australians come to believe inflation pressures will keep compounding, driven partly by budget deficits and green energy investment costs, the bank may have to engineer a slowdown comparable to the recession of the early 1990s. The bank has raised rates at its past 3 consecutive meetings. The cash rate is now squeezing the same household budgets the gas reservation policy is supposed to protect. Higher mortgage costs reduce spending capacity. Higher energy bills reduce it further. The 2 policy tools, gas price intervention and monetary tightening, are pointed at the same household cost problem from opposite directions. The historical parallel the Santos chief invoked is instructive but inexact. Argentina's gas industry suffered under a price freeze imposed during a currency crisis, not a reservation mandate. The mechanisms differ. What makes the parallel live rather than rhetorical is the underlying dynamic. When producers cannot recover the cost of new capital investment, they stop making it. The timing is the variable Argentina got wrong. Governments typically intervene when prices are high and politically visible. The investment damage registers years later when prices are high again and the supply simply is not there to respond. Australia's decision window is narrower than Argentina's was because the Bass Strait decline is already underway and the LNG export infrastructure is already built. The question is whether the new fields get financed. The condition for the gas industry's warning to prove accurate is specific. If the reservation policy's final design, still being negotiated, with the Albanese government promising to get it right, sets a domestic price floor that is materially below the LNG export netback on a sustained basis, new development decisions will begin to shift. The Santos and Woodside capital allocation meetings happen now, not in 2030. If the gap between the mandated domestic price and the export equivalent exceeds the margin needed to justify new field development, the next supply contract signed offshore will not be matched by new domestic investment, and the shortfall will widen on schedule. The condition for the gas industry's warning to be wrong is equally specific. If the reservation design preserves enough return on new domestic supply to remain competitive with capital deployed elsewhere, the production base holds and the shortfall narrows before the deadline. The government's stated goal is to get the design right. The July 2026 implementation date means the design has to be credible to investors before the end of this year. Woolworths at $37 is the near-term benchmark the market set today. Gas investment economics do not resolve in a single session. What the next few weeks will show is whether the policy draft that emerges from Canberra treats the Argentina comparison as a warning to be designed around or a negotiating tactic to be dismissed. One reading narrows the problem, the other locks it in. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.